Intel crushed Wall Street's second quarter expectations, delivered its fastest revenue growth in more than 15 years, and raised its outlook. Yet the stock could not hold the celebration, reversing from an early gain into a sharp intraday loss. So, if AI demand is accelerating and Intel's turnaround is improving, why did investors sell the stock? The answer is not that the earnings were secretly bad. It is that Wall Street is now asking a harder question about the cost of growth. The numbers were genuinely strong. Revenue reached $16.1 billion, up 25% from a year earlier, and well above the $14.4 billion analysts expected, while adjusted earnings were 42 cents a share versus a 21-cent estimate. Data center and AI revenue jumped 59% to $6.3 billion, and Intel guided third-quarter revenue to between $15.8 billion and $16.8 billion. Intel also reported a large GAAP loss, but that figure was heavily affected by a non-operating mark-to-market charge, so it should not be confused with the direction of the underlying quarter. The first reaction reflected that strength. Intel rose about 6% before the opening bell and traded as high as $106.79. But during Friday's session, the shares reversed below the previous close, while the broader semiconductor index also fell. This was still an intraday move at our research cutoff, and no source can prove one single cause for every trade. What we can say is that the reversal arrived as investors were already questioning rising AI spending and weakening cash flow conversion across big technology companies. That context matters because Intel raised its planned 2026 capital expenditure from $18 billion to $20 billion and expects investment to remain elevated. More spending is not automatically bad. It can signal real demand, tighter capacity, and confidence in future customers. But a stock prices the cash a business may generate after paying for factories, equipment, clean rooms, and advanced manufacturing, not revenue growth by itself. The stronger the spending cycle becomes, the more evidence investors need that those billions will create durable margins and acceptable returns. That gives us a clean confirmation test. The cautious interpretation gains credibility if Intel cannot reclaim its post-earnings high, semiconductor weakness persists, and future reports keep shifting attention from revenue growth toward capital intensity and free cash flow. It weakens if Intel decisively recovers that high, and later results show that higher investment is translating into stronger margins, cash generation, and foundry customers. The next clues will come from Intel's execution, upcoming Microsoft, Meta, and Amazon results, and the Federal Reserve meeting on July 28th and 29th. The calm verdict is simple. One reversal does not prove Intel's turnaround is broken, and one blowout quarter does not prove the investment cycle will pay. AI demand is real, but the market is becoming less patient with growth that consumes more capital before producing more cash. Price was the surface reaction. The deeper message was a stricter return on investment test. Intel passed the demand test. Now it has to pass the cash flow test.